call to Meera for the opening remarks, and look forward to an engaging session as always. Thank you, Meera, for joining us, and thanks, Metropolis management. Over to you guys.
Thank you, Anmol. Good morning, everyone, and thank you for joining us for the Q4 FY21 earnings call. I hope you and everyone around you is safe and healthy, and I'm joined today by Vijender and Rakesh and SGR IR advisors. The presentation and press release have been issued to the exchanges and uploaded on the company's website. I hope everyone's had an opportunity to go through the same. It gives me immense pleasure to share with you that our company won the Leading Diagnostic Chain of the Year award at the Diagnostics Leadership Summit held in February 21, recognizing us in this most challenging and eventful year for our industry. Besides this being a successful year for us in taking care of patients, I'm happy to announce it was also a successful year for us as a business. We recorded highest ever yearly revenue, EBITDA and PAT during 21. Revenue grew by 17% YOY, EBITDA before CSR and ESOP grew by 29% YOY, and EBITDA margins expanded by 290 bips and PAT grew by 44% year-on-year. Let me start by giving you a quick snapshot of 21. Most of the unorganized diagnostic sector has been negatively affected this year as regular patient visits to doctors and therefore diagnostic labs are affected. Since these labs did not qualify to do COVID testing, they have been less visible and experienced by patients during this time. For Metropolis, we were able to quickly scale up with COVID facilities and COVID revenues fill the gap created due to the disruption in healthcare services. While COVID revenue formed 29% of the total revenue in Q1 and rose to 34% of the total revenue in Q2, in Q3, as cases moderated and price per test came down, it stood at 19%. The lower contribution in Q3 is also a factor of normalization witnessed in the economy, leading to full recovery of non-COVID business in Q3. In Q4, in spite of conducting the highest amount of COVID tests, COVID revenue contributions stood lower at 14% of revenue due to lower prices. Our conscious decision to focus on non-COVID revenues from Q1 has helped not only to early normalization of non-COVID revenues, but move to a positive growth in Q4. For the unorganized industry, non-COVID revenue normalization has still not happened. The important point to note here is the non-COVID business grew strongly by 12% quarter-on-quarter in Q4 and 22% year-on-year. Let me also share with you that our NACO contract has been extended. It's a prestigious PPP contract for us and enforces our confidence in our scientific and on-ground execution capability. Our progress during FY21 on our KPIs has been as follows. Number one, improved the revenue share of B2C business. Our revenue share of B2C in focus cities for non-COVID increased to 58% from 56% in FY20. Our near-term vision is to take this to 65%. Considering that Metropolis has done 63% of COVID business via the B2C channel in focus and seeding cities, this has allowed 8 lakh new consumers to experience our services and brands. This will be a big opportunity going into the next few years. Further, I would also like to highlight that our efforts during COVID period have strengthened our brand in North and East of India. North India, for instance, now contributes to 10% of sales in FY21 versus 9% in FY20 on an enhanced revenue base, thus signifying the improved visibility for our brand. Number two, the increased revenue contribution of specialty tests. Our revenue contribution from specialty tests and non-COVID increased to 42% in FY21 from 37% the year before, increasing our revenue per test and making us even more relevant to patients' treatment, therefore increasing the stickiness of the business. Number three, ramp up in home test offerings. Revenue from home tests for non-COVID has increased by 22% year-on-year to 80 crores in FY21. If we include COVID, then on an overall basis, our revenue from home testing more than doubled to 136 crores in FY21. This channel is profitable for us and allows us to serve patients in areas where we may not have had physical distribution. This scale of standardized and quality home services for testing is unique in India and challenging to build due to barriers of entry, which are intense management skills, trained manpower, logistics expertise, automation, and brand. Number four, digital efforts have shown great results. While our efforts to enhance customer experience through revamp of app websites, optimization of digital presence and marketing efforts, all working in sync with a customer-first approach, we witnessed 15x increase in website traffic, faster growth in home visit revenue, and 10x increase in call volume. As a result of these efforts, about 80 crores of revenue came through leads generated via digital medium, which is about 8% of FY21 top line. Adding new customers to digital reach has helped in normalizing the non-COVID revenue much earlier than others in the industry. Let me now share with you the growth drivers for FY22 and beyond. From 17 to 20, since Metropolis already had a large back-end lab network with established regional reference labs and stat labs, we primarily expanded our collection center network from 300 in 2016 to 2,500 in an asset-like manner by 21. In 2021, we paused and consolidated the network, focusing on hygiene and productivity. We believe it's now time to again move into an expansion mode, this time for labs and collection points. As of March 21, we have 125 labs and a network of 2,555 service centers, comprising of associate referral centers, owned and third-party service centers. Of these, 1 is the global reference lab, 13 are regional reference labs, and the rest are stat labs. Our key idea over the next 3 years is to add 90 more stat labs and about 1,800 service collection centers. While the labs will be a combination of greenfield labs and lab on lease contract, 1,800 service centers will be primarily third-party service centers, leading to a asset-light expansion. This network expansion will give us entry into 100 to 150 more cities in India. The expected capex investment will be approximately 30 to 35 crores over a 3-year period. Our network expansion will be of 2 types. In states like Maharashtra and Gujarat, where we have a strong brand and we believe we can go deeper into tier 2 or 3 towns. And secondly, in states where we have built some revenues to a franchise route and now want to establish ourselves to our own labs in a bigger way. These states would include Madhya Pradesh, Uttar Pradesh, Orissa, Jharkhand, Telangana, and Andhra Pradesh. This expansion plan is expected to have an impact of 75 to 100 bps on the EBITDA margin in the first year. But on the back of various cost optimization initiatives we are undertaking, we expect to be neutral on overall consolidated margins as a result of this expansion. One of the biggest differentiators and benefits of the current Metropolis infrastructure is that we have already built the required infrastructure in terms of 13 regional reference labs spread across the group, and therefore do not need large investment in capex needed for new regional reference labs or the margin dilution that it causes for many years when you set one up. The stat labs will attach to these existing regional reference labs, and take the new labs which we're going to build will attach to the existing RRLs for more specialized testing needs. With more volumes coming into the regional reference lab, we will enjoy operating leverage benefits. Along with this physical brick-and-mortar expansion plan, we would also be accelerating the virtual channel of home testing. The widening of physical centers also increases the demand generation for home testing services in that area. We have expanded our home visit coverage to 60 cities as of March 21. Our target is to be at 100 cities in this year, FY21-22, and 200 cities by 23. This strategy will enable us to move closer to the customer we acquire via digital and other marketing channels and have a lasting impact on the customer in terms of a superior experience. Home visit business also helps us move towards our increased B2C KPIs and enjoys a better margin profile, enhancing the overall profitability of the company. Our brand recall in most of the 200 cities we operate in has been higher today than the pre-COVID era, and I'm happy to share that a key trend we witnessed was the conversion of first-time COVID customers. About 8 lakh new customers experienced the service of Metropolis for the first time through COVID tests, out of which about 10% have already come back to Metropolis for non-COVID tests. In an industry where most consumers use services only once a year, the fact that 10% have come back only in 6 months speaks volumes of the opportunity at hand. The next thing we're going to focus on is making the brand bigger. With building the digital ecosystem for testing through all the platforms we have shared in past calls, we are also keeping ourselves ready for any business opportunity or partnership in various healthcare complementary verticals such as e-wellness, teleconsultations, or e-pharmacy. We have also welcomed Mr. Girish Singh as the Chief Consumer Officer to lead the digital-to-consumer part of the business. Girish comes from Uber with rich experience in heading the business and marketing vertical. Our current contribution from direct-to-consumer is 8% of total revenue. Our target is to reach 15% revenue contribution through digital leads by end of this year and increase it to 1/3 of our revenue over the next 3 years. Illness and wellness are both categories that we'll be focused on, and with significant investments going into scaling up the wellness category. We are ready to make these investments needed to make this happen. With all this, we believe we have a good visibility of margin uptake as compared to FY21, and the drivers of this will be: number one, improving the B2C contribution, especially in focus in seeding cities via network and home testing expansion. Number two, increasing geographical spread into 100 to 150 new cities via physical and home service ramp-up. Number three, increased volume and revenue contributions from our profitable specialized beds. And number four, optimize overhead costs on the back of digital integration, resulting in better productivity and efficiency. Let me now update you on the High-Tech Diagnostics acquisition. As you are aware, we have got the shareholder and other regulatory approvals for concluding the said transaction. The acquisition was to be concluded in this month. However, the selling shareholder's family, all the shareholders and their families are in poor health as we speak, and this is coupled with a lockdown situation in Tamil Nadu. As a result, the completion of acquisition is delayed. It is important to note that with this delay, our approvals for share issuance as part of the transaction received from shareholders, stock exchanges and SEBI will also lapse. In view of the same, we will need to seek fresh approvals from all. We have been advised by our legal advisors that this process could take 2 to 3 months. Once the shareholders' health of the sellers is better, we will pick this up and keep you updated around the progress of the transaction. Let me conclude by saying that at Metropolis, we remain very upbeat on business and believe the journey of market share shift to organized players will intensify over the short to medium term. We continue to explore interesting inorganic opportunities that are in line with our strategic vision as well. We are thankful to all stakeholders, especially our employees, who have worked tirelessly in this challenging time and not only served humanity but also strengthened the Metropolis brand. That's all from my side. Vivinder will now take you through some of the operational parameters.
Hi, thank you, Ameera, and good morning, everyone. Let me first start by congratulating Ameera on receiving the Entrepreneur of the Year award by EY in Life Sciences and Healthcare category. And Rakesh, our CFO, was awarded at Annual CFO Awards for exceptional contribution to the world of finance. Receiving recognition during such challenging times reflects the strong pedigree of the management skill in the game. Let me now give you a perspective on our operational parameters. For Q4FY21, we reported patients visits of 3.2 million, registering a growth of 29% on year-on-year basis. Even on quarter-on-quarter basis, it grew by 19%. On full-year basis, we recorded patient visits of 9.8 million as compared to 10 million in FY20, almost similar to last year levels in spite of severely impacted Q1. During Q4FY21, we conducted 6.5 million tests, 23% more tests year-on-year. On quarter-on-quarter basis, it grew by 26%. On full-year basis, we undertook 19 million tests as compared to 19.6 million tests last year. For Q4FY21, revenue per patient, including COVID-19, increased by 9% year-on-year to rupees 920. On non-COVID basis, it grew slightly better at 10% year-on-year to rupees 925. On full-year basis, revenue per patient, including COVID-19, increased by 19% year-on-year to rupees 1015. On non-COVID basis, it grew by 6% year-on-year to rupees 905. For Q4 FY21, revenue per test, including COVID-19, increased by 15% year-on-year to rupees 452. On non-COVID basis, it grew by 7% year-on-year to rupees 418. On full-year basis, revenue per test, including COVID-19, increased by 20% year-on-year to rupees 524. On non-COVID basis, it stood at rupees 433, almost similar to last year levels. Most of the variation during the year was due to higher price COVID tests at the start of the year and gradually lowered down towards the end of FY21. Our revenue profile among focus feeding and other cities stood as follows. Focus cities, 5 cities including the city and peripheral area around metropolitan region, contribution increased by 400 basis points from 56% in FY20 to 60% in FY21. Seeding cities, 8 cities, including the city and the peripheral area around the region's contribution has moved from 19% in FY20 to 21% in FY21. Higher revenue contribution from focus in seeding cities is attributable to our focused marketing and branding initiatives in these areas. The rest of the other cities contributed 19% of the revenue in FY21. Our revenue share of B2C business in focus cities for non-core business has increased by 200 basis points from 56% in FY20 to 58% in FY21. With the increasing marketing initiatives toward the B2C side of the business, we are confident to reach our target of 65% soon. With respect to geographical distribution on full year basis, revenue contribution from West region was 58%, South contributed 24%, North contributed 10%, while rest was contributed from East and international locations. With respect to test mix on volume and value basis, during FY21 for non-core business, the volume contribution from specialized tests increased to 16% as compared to 14% in FY20. Revenue contribution from the same increased to 42% in FY21 as compared to 37% in FY20, in line with our strategy. The volume and value mix overall continues to see improvement. To conclude from my side, the key factors which will lead the next leg of growth at Metropolis will be ramping up the non-COVID business and home visit testing, improving profitability through increased B2C business, better test mix and cost optimization initiatives through digitization, automation and strengthening the brand equity of Metropolis through continuous improvement in customer experience and focused marketing initiatives. That's all from my side. I will now ask Rakesh to take you through the financials. Thank you.
Yeah, thank you, Vijender. Good morning to everyone on the call. Let me give you a snapshot of our financial performance. Q4 financial year 21 revenue stood at rupees 292 crore as compared to 206 crore in Q4 financial year 20, up by 42% year-on-year basis. On quarter-on-quarter basis, it grew by 6%. Non-COVID business contributed 86% of the revenue, while COVID contributed the rest 14% of the revenue during quarter 4. Non-COVID revenue stood at rupees 251 crore in Q4 financial year 21, up by 22% Y-on-Y. Even if we normalize March 20 considering no lockdown, we would have still posted strong growth on Y-on-Y basis in quarter 4. Even on quarter-on-quarter basis, non-COVID revenue grew by 12%. For financial year 21, revenue stood at rupees 998 crore as compared to rupees 856 crore in financial year 20, up by 17% Y-on-Y. Non-COVID revenue contributed 77% of this revenue, while COVID contributed the rest 23% of the revenue in financial year 21. EBITDA before CSR and ESOP stood at rupees 103.5 crore in quarter 4 financial year 21, as compared to rupees 51.7 crore in quarter 4 financial year 20, doubled on Y-on-Y basis. On quarter-on-quarter basis, increased by 15%. For financial year 21, it stood at rupees 301.1 crore as compared to rupees 233.4 crore in financial year 20, up by 29% Y-on-Y. This is the first time we have crossed 100 crore EBITDA in a quarter and 300 crore EBITDA in a year. EBITDA margin before CSR and ESOP expanded by 1040 basis point year-on-year and 290 basis point quarter-on-quarter to 35.5% in quarter 4 financial year 21. For financial year 21, it expanded by 290 basis point Y-on-Y to 30.2%. Margin expansion is attributable to operating leverage benefits playing out due to increased scale of business, better tax mix and cost optimization initiative undertaken during the last year. Q4 financial year 21 PAT stood at rupees 61.3 crore as compared to rupees 15.5 crore in Q4 financial year 20, up by 296% Y-on-Y. Quarter 4 last year had an exceptional item and therefore it is not exactly comparable, but even on Q-on-Q basis, PAT grew by 5%. Financial year 21 PAT stood at rupees 183.83 crores as compared to 127.6 crore in financial year 20, up by 44% Y-on-Y. Q4 financial year 21 PAT margin stood at 21% as compared to 7.5% in Q4 financial year 20. Financial year 21 PAT margin expanded by 350 basis points year-on-year from 14.9% in financial year 20 to 18.4% in financial year 21. We have continued to focus on our collection efficiency. Our debtors days has improved from 55 days in March 20 to 41 days in March 21. That is an improvement of almost 25%. Overall working capital has improved from 11 days in March 20 to 4 days in March 21. Our liquidity position remained very strong with cash and cash equivalent of rupees 428 crore as on March 21. OFC to EBITDA stood at a very healthy average of 86% for financial year 21. Return ratio continues to improve. ROCE of 40.9% and ROE of 30.6% is recorded during financial year 21. It's an improvement from the last year. That is all from my side. We now leave the floor open for Q&A. Thank you.
Thank you very much. Before we start the Q&A session, a disclaimer to the participants. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risk and uncertainties that are difficult to predict. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Good morning, Ameera and the team. First of all, congratulations for not only good performance, but also your tireless efforts to, for Indian citizens in this very difficult time. So congrats for that and thanks for that. I have 2 questions. First is, again, you have shared very good insights about your digital initiatives. So, can you tell us that in terms of, since there are many new customers, first time probably customers of Metropolis, how do you plan to, use this, data to convert it into, non-COVID related revenue? And my second question is, in last 12-18 months, which was very difficult period for many, standalone laboratories, do you see consolidation in the industry and winning the further market share? How do you see that opportunity? Thank you.
Sure. So thank you firstly for the kind words. As far as the COVID patients that have used our services and how we can move them, so what we have done actually in the last year is set up 2 things. One was setting up sort of a CRM automation program where as consumers come into the system, we are able to mine the data and be able to do an automation marketing campaign to them for things that are relevant to them. So for example, if we know that somebody had come in for a diabetes issue, then we are able to go back to them and ask them to look at other tests which are related to their diabetes issue, so that whatever promotion we are doing is very scientific and based on a requirement of a patient and not just push. So therefore, similarly, the patients who have come in from a COVID testing perspective, there will be many allied tests which they will require over the course of the next year. Beyond that, beyond COVID, they will also require wellness checks just to make sure that immunity, their body is doing well, their families will need it. And of course, as and when they get sick again for any other reason, the experience of Metropolis, which we will continue to engage with them on, hopefully will be something that they will remember and want to come back and use our services. So it's really going to be all about making ourselves available, accessible, from a time perspective, as well as from a quality of experience perspective. I think one thing which this pandemic has definitely done is brought into focus the requirement and need for good quality testing facilities. And therefore, people are now, I think, not willing to just go to any lab. I think there is certain brand recognition.
Requesting all the participants to please stay connected while we reconnect Ms. Ameera Shah.
So, Amol, can I take this till Amira joins?
Ladies and gentlemen, we have the line for Ms. Amira Shari connected. Thank you, and over to you, ma'am.
Hi, everyone. Apologies. So as I was saying, I think this movement, not obviously all patients will, transition from COVID to non-COVID, but we do believe that with our scientific efforts, with our availability, accessibility for home services and collection centers, and that's one of the reasons we want to continue to expand the distribution and the infrastructure, whether it is physical brick and mortar or more virtual in terms of home collections. And we believe by making ourselves more accessible immediately in terms of spot visits as well will be very helpful in doing these conversions. The second question which you asked about, individual labs and do you see more consolidation? I think at this point of time, individual labs, frankly, I don't see many buyers because the lab sizes tend to be quite small. So yes, there will be many individual labs who will be happy to sell. But I really don't see buyers who are going out to take the individual labs because the process of acquisition, as you know, is very, very painful, especially when it comes to a lab which are not at all mature because their systems will not be in place. But we are seeing a slightly more hectic M&A activity around the more medium-sized regional labs. The regional labs have done well during this pandemic because the COVID revenues that they have got have actually outsized their non-COVID revenues. And therefore, quite a few of them are keen to capitalize on it and to look at doing some transactions. So yes, I do believe we will see a good amount of consolidation.
Great, ma'am. Thank you for providing those insights. Wish you all the best. Thanks.
Thank you. The next question is from the line of Chandramouli Muthiah from Goldman Sachs. Please go ahead.
Hi, good morning, and thank you for taking my question. My first question is on the margin performance. This quarter, the reported EBITDA margin seems to be 33% versus 31.5% in the previous quarter. I can see you've mentioned in the presentation cost optimization, automation, scale of business as factors that drove the operating leverage. In the context that there's been COVID testing price caps, which would typically be margin dilutive, could you provide some additional color on specific factors that offset this factor and if these are sustainable in a post-COVID world?
So I think a few areas that we have worked quite a bit on in the past year and a half. I think one thing which we had already mentioned was that we were signing new contracts with suppliers, which benefit we got, most of last year. And therefore, that definitely helped in terms of the margin. These are vendors who provide us machines and reagents, chemicals, etc. The second activity we had also done was really look at productivity of our team. And where there is work that is very manual that can be automated, and therefore we were also able to cut a lot of costs because of making teams far more productive. Number three, I think many of our processes were tending to be more manual in nature before. And because of this, sometimes we did not have clear data visibility on exact things. So let me give you an example of logistics, for example. Earlier, while we had obviously logistics team, the management of the logistics team was manual. And therefore, they would submit bills, let's say, for example, for a certain amount of travel or a certain amount of kilometers that they were traveling, and bills were paid to them accordingly. When we have automated this logistics automation, through logistics automation, the data about how much they are traveling, how many pickups are happening, what is the cost, etc., all of this allows us to have more visibility. And therefore, we are able to take actions based on this new data that we now have. So this kind of automation at the back end, we have done in various areas, which is giving us far more insight into how to better manage the same function. And it's therefore helping us make it leaner and more efficient. So I hope that answers your question.
Got it. That's helpful. My second question is on the non-COVID business. You've mentioned that you expect non-COVID business to remain healthy as vaccinations are ramping up. Is that comment more in the annual sort of FY22 context? And specifically, given the lockdowns recently in most states, do we expect some near-term moderation in non-COVID business?
Yes, absolutely. I think that comment was from an annual basis, not from a quarterly basis. I think things are so uncertain in India right now that I think it would require the hand of God to predict what's going to happen on a quarterly basis. But in our estimation, as lockdown is quite significant in the first quarter of this year in most states in the country, there is some effect of that on non-COVID business. But again, there has been that usually happens when COVID business increases. So usually there is a balancing act between the two. Our expectation is if things go the way they are supposed to go, quarter two, things will be normalized and hopefully move into a positive growth in non-COVID because COVID will be low. Now, if a third wave happens, then obviously quarter three, we may see a repetition of quarter one. So I think we'll just have to wait to see the direction goes. My personal opinion is that vaccinations will only start picking up from July onwards, and therefore, it is quite likely that we may see a third wave because by the time we are able to actually complete vaccinations, even in cities, we'll be closer to December.
Got it. That's very helpful. Thank you very much and all the best.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Nikhil Mathur from Ambit Capital. Please go ahead. Mr. Nikhil Mathur, your line is in talk mode. Kindly go ahead with the question, please. As there is no reply from the current participant, we move to the next question from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thank you for taking my question. Meera, we laid out quite a detailed expansion plan in labs and collection centers. We've always maintained that, Metropolis is fairly young network and a large part of our expansion has happened only in the last 5-7 years. So just wanted to understand, are we facing capacity constraint which is leading to this expansion, or is this effort more because you think M&A is unlikely to boost growth, accelerate growth, and therefore it makes no sense to do it organically? I'm just trying to understand why the aggressive expansion plan now.
Sure. Actually, neither of the two reasons, Neha. The reason is very simple. Today we operate in about 200 cities in the country. When you see that we have got 125 labs, those are probably in about 100 cities across the country, which means that between the 100 and 200, where 200 where we have collection centers and network points and all of that, but we don't have lab premises, right? Now, usually when you go into a city, let's take for example, we've gone into Bhilai, and in Bhilai, we have a franchise or a collection center where we are picking up samples and we are sending it to the closest lab from Bhilai. Now our business in Bhilai has built up to a certain level, but we were only getting specialized tests because obviously we were not able to give the routine tests because we didn't have local processing. Now we believe our brand has built up in that market enough that it justifies creating a new lab in Bhilai that will not only do routine tests locally, but continue to pick up those tests in Bhilai and send them to the closest lab for specialized tests. So we are actually expanding a whole category of customer, which is the routine tests, which earlier we had no access to in these 100 cities, right? So the idea of always going into a new market with a franchise or with your own collection center is to build up your brand, to build up certain volume, and then follow it up by opening your own lab. And that's just what we are doing as a natural progression of the cycle that makes sense to us in pathology. So the next step is as we build these 90 labs in these 100 cities where we have already built some brand, we will then expand our franchisee collection centers to another 200 cities. So hopefully in the next 3 years, we will be present in 350 cities to 400 cities, where again we would have labs in 200, but there would be another 200 in which we are building our brand through collection centers and picking up samples. And that's how the growth journey continues to move as we continue to expand across the country.
So does this essentially accelerate our growth, now because one, we are able to capture a larger wallet share for, patients, and two, we're also entering new markets. Is that the way we should look at it?
Sorry, I couldn't hear your question. Could you repeat that, please?
I'm just wondering if, does this accelerate the growth that Metropolis has been seeing, because it allows us to capture a larger wallet share for, patients that we were already catering to, and also probably enter new markets or new customer that we have acquired through COVID, and new cities that we have, entered through COVID. Is that the way we should look at it?
Absolutely. I think what's happening with COVID also is that there are big changes happening in population movement, right? As we are seeing, there are patients or people, consumers who were living in cities who are now moving back to their hometowns, saying they don't want to be in cities anymore. So it's also, there's a lot of movement happening in the country as well. And therefore, people, let's say, who are coming into cities for healthcare or for jobs or whatever, we will probably start to see some movement back to their smaller towns as well. And therefore, we think it's important to also reach out and set up that kind of infrastructure in the smaller towns. But we don't know yet whether we are going to land up seeing a lesser growth in the metro cities because of this. I think this is an unknown. So the sense I have is that in the metro cities, we will see a movement from unorganized to organized. And then when we go into these smaller towns, it will take us some time to set up there, really build a brand, to really escalate. So there will be a push on growth overall as an organization, and that's the idea of this geographical spread, and really moving out there to get into new geographies and markets that we were not present in earlier.
Understood. And my second question is on the, making the brand bigger. You mentioned, partnership with, focusing on e-wellness, pharmacy, teleconsulting. And you mentioned the B2C revenue component, which from 8% to 1/3 over the years. What exactly is that? Is that digital? I couldn't really understand what you were referring to that.
Sure. So currently, 8% of our revenue comes through digital channels, right? Where we acquire consumers and patients through digital channels, and we fulfill those services. That's currently 8% of the revenue. We indicated that we would like this number to increase to be closer to 14 to 15% by the end of this year. And we would like this number to escalate to becoming closer to about 30% in 3 years. And the second point we mentioned, which was separate, was that we are open to exploring expansion of our services beyond pathology to also things like e-pharmacy, teleconsultation, and we are exploring that option to see whether there is synergy and it makes sense in terms of creating a larger digital health ecosystem. But our core business continues to expand from a digital perspective from 8 to 15 to hopefully 30. That plan will continue while we explore all the other areas as well.
So the 8 to 30 does not include, it's not dependent on any, doing partnership or none of that, right?
No. We are assuming, obviously, as the market evolves, there will be certain opportunities that will come our way, but no, it's not dependent on pharmacy or consultation at this point.
Understood. Thank you so much.
Thank you. The next question is from the line of Nikhil Mathur from Ambit Capital. Please go ahead.
Yeah, hi. I hope I'm audible now.
Yes, sir, you are.
Yeah, sure. Thank you so much. Yeah, so in the opening remarks, when you were talking about the expansion activity over the next 3 years, there was also a comment made that there might be some 75 to 100 basis points of margin dip in year one. So is my understanding correct that we are talking about FY22 here? And a question associated with this would be, are we talking about this margin dip on a full year FY21 base of 29% EBITDA margin or 9 months base of 32%? Because in 1 2 there was enormous reduction because those margins are lower.
Sorry, I'm not able to hear you clearly. It's a bit muffled for me. What I heard you saying is that you're asking us to explain the margin dilution of the 75 to 100 bits. Is that right?
Yes, yes.
So basically, as we expand approximately 30 labs per year and 600 collection centers, as we mentioned, per year over a period of 3 years, we are expecting that there will be obviously some margin dilution that will happen, which we are estimating to be 75 to 100 bits. Because obviously, as we expand into more labs, there will be more fixed costs, there will be efforts that will go into setting it up. It's not going to break even from day one. There will be some operational losses for the first year or two. And therefore, we said that this will be margin dilutive for a bit. Secondly, we said that we have initiated other cost initiatives which would potentially save us equivalent amount of savings through efficiency that would therefore neutralize the 75 to 100 bits margin dilution which would happen because of the expansion. And therefore, we do not believe that overall we should see dilution on the margin, but that's how we were explaining it.
Okay, and what base are we working with here? Is it the 9 months base of 32% EBITDA margin or full year FY21 EBITDA margin of 28%, 29%?
We are considering the whole year. So the same way we are considering the whole year for FY21-22.
Okay. And second question is regarding the Hitech acquisition. Now, first and foremost, wishing a speedy recovery to Hitech's management. Can you help us understand how Hitech's financials are shaping up? We had an update for 9 months when the acquisition was announced. So how has the full year closed for them? Any color on growth and margins and output would be really helpful.
So
I think, yeah.
No, ma'am, you can go ahead. If you want, I can check it.
So, yeah, thanks. So Hitech has obviously done, well, performed well, like most of us have. I think the year, I don't have the specific number, but the year has ended in line with sort of the 9 months. Margins have again been higher than what they were traditionally because, again, economies of scale have benefited the bottom line. So overall, I think the company has ended well. Rakesh, you want to add any more specifics to this?
No, so the other point is that from a non-COVID point of view also they have done well. From overall COVID revenue also has fared well. So overall growth looks very high in terms of top line. And bottom line from the margin point of view, they have performed successfully well. So obviously we don't, because the audited numbers are not yet there, so we can't reveal the exact numbers, but overall they have really done well.
Okay, sure. Thank you so much.
Thank you. The next question is from the line of Prakash Kapadia from Anivet Portfolio Managers. Please go ahead.
Yeah, thanks for taking my question. Couple of questions. So in the near term, do we see major change in consumer behavior, at least in metro cities, in terms of bundle tests being demanded more than before, preventive share increasing, and as we drive to increase our B2C non-COVID business to 65%, how do we actually plan to differentiate, as there is already a need which is being fulfilled by somebody in terms of competitive landscape? And lastly, if I look at the PAT growth of 44%, the cash flow from operations is up just 8-9%. So when do we see operating cash flow matching the PAT growth?
I'll take the first question and ask Rakesh to take the second. As far as the first question, what you're saying is that people's needs are already being met. If today if we talk about pre-COVID, that was there a place where you could go and get a blood test? Yes, of course, there was a place you can go and get a blood test. But what is the quality of your blood test? Is your doctor happy with it? Are you happy with the service? All of those things were not really being challenged. With COVID, what has happened is, number one, something that you as a consumer never really thought too much about before in terms of where I go to get my test, suddenly has become more important, and you are more conscious of the fact that you want to go to a good lab and we want to get it done correctly because obviously the general, certain brands have come to the light during this entire process. That's number one. You've also realized that compared to a local lab on the street, there are few companies like Metropolis which have got a much larger testing capability, more advanced testing capability, which have the ability to do the most advanced tests. So your own consciousness and your own mindset has changed during this period. Along with that, most people have become more digitally enabled and become more used to do things through technology. Now, you may not necessarily want to go back to your same old pasta which was next to your house, where you go and there is no technology engagement. You may not find things super hygienic or clean. And you are looking for an engagement and an experience where you can get on your app or get on the portal. You can either book a visit where you can walk in or somebody can come to your house. Reports are electronic. You can pay online. An experience that you are experiencing with Swiggy or Zomato or Amazon or any of the other companies in other industries. So the combination of these two things happening together, we believe will probably change consumer behavior in a direction that they will prefer to go to an organized sector where they have more trust of the brand, as well as this different kind of digital experience and a professional standardized experience versus the unorganized sector. There is a bunch of research that's actually happening as we speak to try and see how consumer behavior is changing. And this is not, obviously everybody is still in the process of evaluating this, but this is the direction that we believe things are going to go.
And the first question in terms of in the scenario in the near term, do we see that it is increasing, bundle tests increasing from the consumer side? If I get this, I might as well get A plus B plus C at a much lower cost in terms of a package. Do we see that trend increase?
Not really. I mean, I think we definitely see wellness and preventive healthcare becoming more important because people are more concerned about their health. They want to make sure once a year, twice a year, they are in good shape internally. I think that definitely will increase once the pandemic sort of settles down. We do see every time COVID goes up, obviously wellness comes down because people don't want to interact with healthcare services in a COVID time. They want to stay at home and not meet anybody. So the wellness piece does come down when COVID increases. But overall, we do see wellness increasing. But what you're saying of bundling of tests, usually a bundling of tests is done from a pricing perspective. It is not done from a scientific perspective. And what we have to realize is that in our industry, it's more about what each of you needs depending on your health scenario and also what the doctor prescribes. So it's not about us just giving a bundle of tests and people picking it up because each doctor's prescription will be different and each patient will require different tests for their health. And therefore, the wellness bundling will increase, but not necessarily illness bundling.
Lastly, on the cash flow.
Yeah, so I will chip in here. So basically, if you look at, 8% number seems to be a bit, we'll check it out because our cash generation from operation has moved from 279 crore to 305 crores. Basically, which means that there is a 16-17% increase in the cash generated from the business. So we will check with you how you're coming to 8%. That's we'll do it separately. And the point of 44% versus 16%, there are two reasons to it. One is that we have deliberately, invested some money in our inventory, and because of the surge which is happening, and we knew that there will be a lot of demands of certain tests, and we have deliberately kept approximately 10 to 15 crore rupees of extra inventory in our kitty as on March. So that actually is impacting a bit of a working capital. And we have also improved upon our, creditors days from 94 days to approximately 82 days. So that also has helped, helped us in the market. But obviously from a working capital point of view, there is a change of working capital from last year, 28 positive to 16 negative this year, basically, which means that 44 crore rupees of working capital has changed in comparison to last 2 years. So that is one reason for it. And the second reason is that we have taken an exceptional item last year, and that has actually helped because that was not a cash impacting item in the PAT. So that also helped us a bit of a change in the cash position.
And
so I
the
think
inventory which we have built is specifically for COVID related material and
this is COVID and COVID rub-off, yeah. Mainly COVID and COVID rub-off because we knew that this second wave is coming big and we will need this testing in a big scale. So I think deliberately we have ramped up a bit of inventory in Q4, but that and it will get liquidated in Q1. So we will again come to the
that should get normalized in the
yeah, that will get normalized. I hope that answers your question.
Sure. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, thank you for opportunity and many congratulations for a good set of numbers and Amira, very congratulations for your EY Entrepreneur of the Year award. My first question is related to the revenue per patient realization number, and sequentially we had observed there is some correction in that, some around 9% of a correction. So what's the basic reason behind that? Is that COVID business is down as impacted? And also the year we had seen some 19% of improvement. So and also like you had given a plan for expansion in the smaller cities. So how to how you are confident to sustain these numbers from here onwards?
Thank you, Praveen, firstly for the congratulations. I will ask Rakesh or Vijinder to pick up the point in the revenue per sample and revenue per test. But just broadly, obviously this has been a very uncertain year with a lot of price fluctuations based on the government taking decisions on COVID tests and otherwise. I think overall, we've still done well on non-COVID basis as far as revenue per patient, and I think that should be the KPI that we should continue to follow, as we've always indicated before. Your question of as we go into smaller markets, how do we sustain this? I think the important thing is really not to try to sustain the overall number. I think when we dissect the revenue per patient, our own existing numbers into metro cities and smaller towns, anyway there is a difference. The metros obviously are higher, the smaller towns are smaller. And if we are only focused on sustaining the revenue per patient overall number, we'll never be able to grow into these smaller towns. I think what's more important is we should look at the overall growth that it adds and the overall profitability that it adds in time. And while of course we would like to sustain the revenue per patient numbers, that should not become an obstacle for us in terms of pursuing growth. So I'll just ask Vijinder and Rakesh to pick up this decision.
On revenue per patient, I think in Q4 we have seen drastic improvement on the OPDs and IPDs, where patients had started coming for their pent-up kind of demand and some elective surgery. So there was an improvement on that piece. Secondly, I think there's probably the change is happening primarily because of the rub-off tests also. And the contribution of rub-off test is in the range of 3 to 4% in Q4 as well, whereas Q3 was much better. However, the drastic improvement is primarily because of the OPD and IPD.
Okay, so it's a measure to do with the COVID, not the non-COVID business. So, and second question is related to the COVID only.
OPD is, IPD and OPD is related to non-COVID.
Yeah. So, as I can see, there is a correction. So that correction is because of a COVID business only. On the overall realization down.
That's right. If you look at the separate data we have given you for non-COVID, you'll see there is no correction.
Right. Thank you, ma'am. And the second is related to the COVID business. As April, May, as there is a surge in the COVID cases, is it possible for you to share some per day run rate number, how you are doing this? And the last year, full year, how much of a test you have done, COVID test?
I don't think we have that data ready, but I'm sure Rakesh can come back to you with it later.
Okay. Thank you, ma'am, and all the best.
Thank you.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Hi, good morning, and good to see fourth quarter non-COVID patient volumes being in the positive trajectory and low receivables. And we missed the 1,000 crore mark by a whisker. I think hopefully fiscal 22 might have that happen. Thanks for detailing the 3-year vision. That helps. I had two questions. Firstly, on the vision part. So in terms of bandwidth and preparation, could you help me understand what are the gaps to be fulfilled? How do you go through this journey over the next 3 years? Financially, I think obviously cash flows are decent, so I'm not really bothered with that. But to maintain your customer experience, people management, what kind of bandwidth do you need in the company to achieve this plan? If you could throw a bit of more color on that, will be helpful. That's my first question. Thank you.
Sure, good question. Obviously all these things are at the end of the day a reflection of team. And what we did a couple of years ago was actually we decided to rejig some of our top teams. So as you all know, we brought in a new CHRO, we brought in a CFO, Rakesh. We also brought in a new head of service operations, Kanan. And we actually have promoted him now to Chief Operations Officer. So what we are trying to do is to actually, we've already built a good corporate team as well as a N2, N-2 sort of a second line team below them, which has really sort of strengthened the operations. We still find probably one or two positions that we would like to add at the top level, and we are in the process of finalizing those. And we believe that those will also help us in terms of preparing for this plan forward. What we believe is that each of these drivers or pillars of growth needs to have one owner and a person who we can depend on, who takes accountability and drives it. And therefore, we are trying to structure the organization in that way that each of the key growth drivers has got somebody that's really pushing it forward. And then obviously the corporate team at the back supports in every way possible in terms of ease of doing business, automation, helping make business decisions by providing the right business analytics, and giving that kind of visibility into how do you make decisions which are data-driven. So I think that's the general direction we are going in. So we've already added a lot of people, but we will be adding probably 2 more senior leadership people in the next few months, which will also continue to bolster some of the efforts over the next 3 years. On the customer experience side, it's been a challenging year for healthcare because, really how much of an effort our teams put in this kind of a pandemic, it's never enough because there are obviously people who need more help and support. And what landed up happening is for companies like ours and others, there used to be a time when, you were doing 3,000, 4,000 calls a day, let's say in your call center. And in a matter of 1 week, it jumps up to suddenly 12,000 calls a day. Now, those kind of things, when they happen because the wave comes suddenly, is impossible to actually meet up the complete, and be able to pick up every one of those 12,000. So we will have a certain amount of patients who will not necessarily get the best services at that point of time. So the question is really how do we manage those relationships? How do we do service recoveries? How do you continue to show that your brand is well-meaning even when a surge comes and you're not able to give the best service in some cases? So I think it's about just focusing on those customers, focusing on your NPS scores and building the team that gives them the automation, the tools and the resources to be able to really look forward. And that's what we've been really busy doing. I hope that answers your question. I won't be able to give you a little bit more specifics about the positions at this stage, but we're definitely adding to the senior leadership team.
Got that. And second question was on the balance sheet. The data management, obviously, it's been heartening to see the reduction there over last 2 years. Now it's come down almost to 40-45 days of sales. Is it more fiscal 21 specific where the revenue mix is driving this change, or is this more structural? Any outlook you could give for fiscal 22 will be helpful on purely receivable management. That's all from my side. Thank you and all the best.
Rakesh, Vijender, you want to take that?
I would like to take this. So basically, it's a very systemic thing. It's not a one time. Let me just assure you that, because there are a lot of efforts have gone into it where we have created a lot of visibility around the numbers. We have created a lot of controls over it, where the system now has all the rights to see how many days of DSO is pending, and if there is any overdue, it gives a reminder, alerts, block the code. A lot of control has been built in, and we now have a very, very rigorous team which really goes after the receivables. So the whole last year we have really worked on the systemic things And I'm sure that whatever improvement we have done, we are going to see further improvement over it, and it will continue as a journey. So these are all built-in controls, built-in visibilities, which will help us in a long run as well. So I'm confident that this is not a one-time phenomena, and we will continue to improve upon this as going forward. And just to give you a glimpse of how well we have done is that in spite of 145 crore of increase in revenue this year, we are able to reduce the receivable from an overall point of view. I think that something speaks volume of how well the whole receivable has been managed. Thank you.
Got that. Thanks. Thanks a lot. All the best.
Thank you.
Just want to add one point to that during COVID waves and expansion, there was a choice that we had of the kind of COVID business you want to go after. There was government business available, there was B2B business available, there was B2C channels. And I think, Vijender, Rakesh and myself made a very conscious decision that we will pursue more of B2C COVID, using it as an opportunity for the future where those customers then hopefully come back to you for non-COVID, rather than pursuing only government business, which has become a one-time transaction. These kind of conscious decisions have also helped in keeping the credit issues low, because we know that people who pursued the B2B and the government route very strenuously are having challenges from a collection perspective.
Perfect. Thank you. Thanks a lot.
Thank you. The next question is from the line of Samir Baisiwala from Morgan Stanley. Please go ahead.
Thank you, and good morning, everyone. If you take a Q4 as a reference for non-COVID business, then what's the sort of a growth outlook that you would give on a 1 year, 3 year basis? Your thoughts on this?
So, Samir, difficult for us to give a guidance at this point of time, because so much of it depends on the number of COVID waves and surges we will see. Like we indicated in Q1 of this year, with the COVID surge that we all know has happened, it does impact, the lockdowns do impact non-COVID. So therefore, it's just very difficult at this point of time to give a guidance honestly for a year, because it just depends on so many factors which are unknown. So I think the only thing to know, the other thing to state is that with the expansion that we are doing in terms of distribution, physical as well as the home services, the kind of investment we are making into digital as well, I think we should definitely see a fair growth in the next few years, and that's been the idea of really keeping that growth engine going. So I think if you look at our CAGR of growth for the last 3 years, I think our CAGR, despite of COVID, has come to about 16-17%. And I think that's a number that we've obviously been very comfortable historically. Now, assuming that there are no huge challenges which are unseen, we'll have to see if we can continue that sort of trend going forward.
Okay, great. Thanks. And just on this point, how do you think about the rural business in the sense that how underpenetrated is that market, and in the longer term, do you have any plans to cater to that?
So for me, it's definitely a very, very underpenetrated market. But everybody thinks that something which is underpenetrated definitely is opportunity. I don't think that's necessarily the case as of yet. I mean, if you actually look at it broadly, if you see the 70% of public infrastructure that's available, which is government infrastructure, it's all across the country. But that actually generates, they take care of 30% of the healthcare requirements in the country, versus the 70% of requirements of the country are taken care of by 30% private infrastructure. The reason for that is because usually the government is more spread in rural and smaller markets and towns across the country. Of course, they also have their large hospitals in cities, but private infrastructure is more in metros. So where there is a choice, consumers prefer to go to private, even if it means paying, like what we see happening in metro cities. But the same story when you go to rural India or you go to small towns, affordability is a big issue. And if you look at the cost of healthcare actually in smaller towns, it's significantly higher than the cost in metros. To give you an example, if I have to hire a pathologist in Bombay, or I hire a pathologist in Chennai or in Trichy, the cost is totally different. The reason it's different is because it depends on the number of seats of pathology in that state, and people tend to usually stick to their own home markets where they've grown up. They are not very, they don't move much. Unlike business people, doctors don't move much. And if you try to ask them to go to a small town, their costs will go up 3 times. So therefore, I think for private healthcare to really go to rural India and make it economically viable to operate at the same kind of standards that we operate in cities, I think is quite a challenge. So there really needs to be a new model, which is operating at a very different standard, operating in rural markets. And I think at this point of time, from our perspective, there are still enough cities and towns where payment is not such a big issue. It makes sense to focus on those 100, 150, 200 cities first, before reinventing a new model, which will be completely different from our existing model to go into rural.
Thanks a lot. This is great. And just one final question from my side. In your entire expansion plan for next 3 years, I don't think you made a reference to adding new reference labs. Any thoughts over there? And second is, as you know, Dr. Lal is going to open new reference labs in Bombay and Bangalore. So what does it mean for you, especially given that these markets are large for you and quite saturated?
On the first question on not opening reference labs, I actually alluded to that point that we already have 13 regional reference labs. And the advantage of this for Metropolis is that we have already invested in these, we have already carried the cost of these OPEX, and therefore we don't need to make the CAPEX investment or the additional OPEX investment, which definitely comes diluting the margin every time you open a new reference lab. It dilutes your margin for almost 3 to 4 years till you get a certain amount of volume that makes it, it gives you the economy of scale. So for Metropolis, we are already done with that cycle, and therefore we don't need to do that going forward. As far as the other players, labs and their investments, what it means for us is really, today if you look at Delhi, for example, Metropolis already operates a regional reference lab. And obviously that is the core market, for Dr. Lal as well. The market, this means basically that we'll end up competing on the B2B segment in Delhi, right? And in the B2B segment, they will obviously have their relationships and their strengths, and we will have ours. The market is still big enough that can accommodate all of us. It is not a market. And of course, you'll end up competing for hospital segment. And probably the same thing happens in Bombay. There are already many players, and Dr. Lal has already been competing in Bombay for the last 20 years as well. So they will now have a little bit more capabilities with the regional reference lab in Bombay, but I don't see anything drastically changing in terms of something that will affect our practice.
All right, great. Thank you so much, and good luck.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Anmol Ganju for closing comments. Over to you, sir.
Thank you. Thanks, Amira. Thanks, Vijendra. Thanks, Rajesh, for joining us, and wish you all the best, and you guys stay safe, and thanks for giving us the opportunity to host the call. Have a good day. Thanks.
Thank you. Ladies and gentlemen, on behalf of JM Financial, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.